You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Next up is an important panel which highlights how financial advisors have integrated options into their practice. Eric Cott serves as Director, Financial Advisor Education for the Options Industry Council. He is responsible for expanding OIC's outreach to financial advisors. Now, I've had a chance to be with Eric, going around and making presentations. 2 years ago in January, during a driving nor'easter snowstorm in Philadelphia, I get a call from Eric. It says, hey, we have to go do a Options 101 presentation to the state employees retirement system in Harrisburg. I don't know if I can get there. Can you get on a train and be there in case I can't show? Yeah, of course. Who says no to Eric Cott? I get on the train, beautiful weather, half the state shut down, expecting 2 people in the room. And we both arrive at the same time, open the doors, and there's some 50 people there to hear about Options 101. Had really no idea the backgrounds and all the people that are there. We go through the presentation, and we get done, and Eric asks, are there any questions? And the head of the group raises his hand and says, yes. We have never considered allocating money to a financial advisor for options because we never understood about how options work. Now, this is a door opener for us to consider allocation. We're like, wow, that's great. Then another person raised their hand, and that person said, me the same. Other person was the same. And we asked, who are you? Who are you, rather? One of the persons was head of the Democratic oversight for the pension fund. The other one was the Republican oversight. So all of a sudden there was a unity in the room that there's an opportunity for options in state employee pension funds. And this is what Eric and I looked at each other and said, this is the promise of our industry. So without further ado, welcome to what's going to be a great panel, Coffee with Cott. Thank you. Thanks, man.
Good morning. I just hope everybody has gotten an extra cup of coffee because we're going to take you from 0 to 60 in about a half an hour right now. So I would be remiss if I didn't just start off by thanking the NASDAQ, everybody at that exchange, as well as all the other exchanges, and of course the OIC and OCC for giving us the opportunity here to do this. Based on the showing this morning, I might have changed the title of this to Cocktails with Cott. So if Shelley Brown is in the audience right now, might want to think about that for next year, might bring a little bit more of an audience, but this is great. Again, commend you all for being here this early. So what I'm going to ask my esteemed panel, these are all wonderful colleagues of mine, to just, I'll start down at the end there with Mike Galantino, just to take 30 or 45 seconds just to introduce yourself, who you work for, and I guess why I have you here.
All right, Eric, thanks for having us. You always do a great job. I found out from Izzy this morning that you are the poor man's Bruce Willis. So that's a pretty good title. So
thank you for the compliment.
My name is Mike Galantino. I'm the CEO of CV Brokerage, which is a minority firm in Philadelphia. We do a lot of work on the floor of the Philly. I also manage an investment advisory firm, Philadelphia Partners Capital Management. I've been in the business since 1984. I've incorporated options from the late 80s to today, and we're going to go through the process on how we talk to our clients about encouraging them to use options and how it kind of makes a difference from, I think, advisors that use options and once clients understand options to advisors that don't. And there's a number of reasons for that we'll get into, but we try to get started slowly. You know, they trust us as their trusted financial advisor. So the first couple trades are kind of on a trust basis, but after they understand what's going on, I think clients really appreciate the extra work you put in by incorporating options in whatever manner in your portfolio. So
thank you, Michael. And the sort of local representation here, about an hour away here in Jacksonville, and pleasure, Brandon, to have you here.
Thank you. Like you said, my name is Brandon Setlock. I work for Charles Schwab in the Jacksonville, Florida office, just about an hour away. I've been with Schwab about 9 years. Previous to the Jacksonville office, I was in the Austin, Texas one, where I was on the active trade and the options team for about 4 or 5 years. So options are something that's near and dear to my heart, and I've incorporated that into my practice with my clients. And I can tell the clients that actually use options tend to be much happier than those that just let their allocation, let the market take it kind of where it is. So.
Fantastic. And sort of batting cleanup, but some of you might recognize this face from last year. Actually had the longest trip out here from Southern California. Glad to have Paul here with us.
Thanks, Eric. Good to be here. My name is Paul Feinstein. I work for First Republic Investment Management on the private client side. I've been managing money for the last 25 years for high net worth individuals, and my business kind of is encompassing all aspects of active management, and options obviously play a very large role in my business.
Fantastic. So what I'd like to start off with, the three of you, and I guess I'll start with you, Paul, on this. There was a lot of discussion yesterday about February 5th. Again, sort of an iconic day for volatility, and then, a wonderful quarter for OCC. A lot of you heard we had our best quarter. So how did that relate? Here we are, a buy-side panel here. How did that relate with your clients? Did the thought process change? I mean, you've always stuck very, much to a discipline, but did you find certain clients now that weren't thinking about adding option strategies change their mind?
Yeah, I would definitely think that it definitely came to more of the conversations during that time period. Clients were more aware. Clients were more of the dramatic volatility that was now kind of like what we were dealing with on the landscape in the marketplace, and it definitely opened some new doors that people kind of wanted to find ways of utilizing that options in a different way. I run a put right strategy, and that was kind of core to these conversations is how do you harness that volatility.
And Brandon, I know you have a unique perspective because being in a Schwab office, and we were collectively, the four of us, talking about this, and having been a former advisor myself that worked for that firm that had a bull as their logo, I was also intrigued that you have walk-in clients that'll stop in there with millions of dollars to open an account that actually still exists today in 2018. So with what happened in this first quarter, were there situations that you had maybe had a client on the fence or something where you're discussing a strategy, and now with higher interest rates and volatility being on the minds of individual investors and your clients, that things changed, maybe not dramatically, but at least you saw some things that were different?
Yeah, I would say so. So I do a lot more on the covered call side for clients. I find it is a very easy way to get clients into things like options. Last year was an anomaly, as we know. It was pretty much a straight shot up with very, very little volatility. So all the clients that I would talk to be like, well, why would I give up my upside if the market keeps on going upwards? And then February 5th happened, and people realized that stocks can go down in value. So a lot of those clients that were on the fence about starting to incorporate options into their portfolio said, hey, let's talk about that, because any option that you sell, that's premium you're bringing into the account. So it's giving you some amount of downside protection. So when clients realize that stocks aren't just going to keep on going upwards, and we might be in a very volatile, maybe even a flat year like we saw in 2015, the options have become a more and more important part of the conversation. I also do options workshops in the branch, and I run two. I do a basic and then an income and then a hedging and advanced. The hedging one I had scheduled for the very beginning of March. The attendance went from 5 people signed up to 50 as soon as that volatility kicked in. So it's becoming a very important thing for clients, especially if they don't see the stocks just keep screaming to the upside like we saw in 2017 and 2013.
And Mike, I'm going to ask you, I think there was a smaller delta that the Eagles were going to win the Super Bowl last year than there was that volatility was going to be stronger at this conference.
Correct.
So, but being facetious and putting that all aside, asking you about this situation, where you're seeing maybe the mentality change with your clients. And will you maybe see that through the rest of the year?
Yeah. Once the Eagles won the Super Bowl in February, I didn't really follow the options market. I was pretty much 45-year season ticket holder. It's been painful.
The parade is still going on in Philadelphia. I'm sure of that. I know Joe Burgoyne was there.
Right.
Yes.
There was no muggings or murders for 5 days, and they went back to it after the parade. But the Philly fans have a bad rep, so I apologize for that. But to echo what Brandon said, February 5th, the VIX all last year, we were a majority of my business is selling calls. And, at 8, 9, 10, 11 on the VIX, the premiums that we were getting just weren't worth giving up the upside, as you said. So once that happened and the VIX shot up, there was so much opportunity for clients. And clients that have been with me for a long time, they understand that, we're not going to do anything because we're not getting paid to give up the upside. But after February, that all changed. And it just, 20, 30 conversations a day, 5 or 6 ideas, a lot of business came in the door. It just really piqued everybody's activity and business for probably 2 or 3 weeks.
Great. And I want to encourage everybody, I know Dan said this before, but please send in questions through the app. We want to make this more of a dialogue and not a monologue. So if there are things you want to ask this esteemed group, please send that in. So we talked a little bit about this where with advisors who have taken a Series 7, sort of like the driver's ed exam. I know my nervousness was probably more so with the Series 7 than it was when I took my driver's ed test when I was 16 years old, which, boy, was a long time ago. But obstacles that present themselves. We produced a quantitative study last year that a number of you have seen before. Very proud of that at OIC. We released a study with Cerulli. We're still talking about that now. And one of the major takeaways were not individuals like you three that are option-centric, but trying to get the advisors that are reticent to use options. What are some of these obstacles or pitfalls that you think why advisors aren't using it?
Well, from my perspective, I think it's complexity of the product and the intended use of the product. I mean, you can take options, and there's many different ways of using it. And I think advisors have a tough time. And first of all, I think they want things simple, and if they can farm that business out to a third party and have them take on the responsibility, I think that's kind of their preference. Some time ago for me, it was, I live and die by my clients. Clients are going to hold me fully accountable and responsible for the portfolio. So I just took that part of the business under my wing and said if I was going to run money, I was going to do it in the most efficient way. And if options for me just kind of was a natural, no-brainer with, the cash flow component to it. But I think it's, just familiarity, and I think it's just being comfortable with a certain product.
So that familiarity and maybe, Michael, keeping things simple?
Well, I think I would add that financial advisors in general are the path of least resistance, and I don't want to say lazy, that's too strong of a word, but in this fee-based model that everybody's moved to over the last 25 years, you could have a 35, 40 stock portfolio long only, and you move on to the next client. And, when you incorporate options, it takes a lot of time.
Right.
And it takes a lot of effort, and it takes a lot of compliance. And so a lot of advisors out there, they, like you said, they would rather outsource through Parametric or somebody the options side of it. But to Paul's point, I think the real advisors out there that incorporate options and can talk about options have a distinct advantage over the guy that, a guy inherits $5 million. He goes into the big wirehouses and he basically gets the same pie chart that says large cap, small cap, mid cap, whatever. And I think when you incorporate options, and I've impressed this upon, and I've run advisors for the last 25 years, having the ability to talk about options is, and intelligently, is a huge advantage. So the real big advisors out there, like Paul and Brandon, they use options because it's part of their asset gathering and referrals, and your guy does options, my guy doesn't do options. Oh, really? Had conversation with Paul. Oh, really? That's what you do? So it's more of a business generating device. But I do think that a lot of advisors, the path of least resistance, get the assets, charge a percent, move on to the next client, get another account, and they don't really focus on running the portfolio utilizing options.
So Brandon, thinking about options as an asset allocation sleeve, and how it becomes, and that's something that we uncovered with the Cerulli study and prior quant studies that we did at the OIC, that options are a differentiator. that they sort of set you apart. And so has that been a benefit to your practice? Because, you came from a sort of different perspective, and now, being a branch manager there, does that open the door for other relationships because it's differentiating you from, say, the other competition in the area?
Yeah, I'd say it's probably two parts on that. So first, if you have a client, like most of our clients, if you live in Florida, are retired or getting to that age, a lot of them are living off the income off the portfolio. Interest rates for the last decade haven't been cutting it. So if you're doing something like put writing, covered calls, et cetera, and adding 2, 3, 4% to a portfolio per year, that's less reliance that they have to have on the market. So if they go into another firm that's a long-only portfolio and they're looking at a dividend of 2.5%, and we can do the dividend of 2.5% and add 3 to 4% with covered calls, now it's a night and day difference. And the guy down the street's probably not talking to them about that. Secondly, perception is kind of everything. So I don't know if you guys have experienced this, but like 2013, 2017, you could not go wrong just buying stock and holding it. I can't tell you how many people had come in to speak with me that said, hey, take a look at my statements. It looks like my advisor placed 3 trades last year and charged me $30,000 in fees. I just want to make sure I'm reading this right. Because all they did was hold the portfolio, and it just went straight up in value, and they didn't have to do anything, didn't have to rebalance because everything went up lockstep. And that perception that they're paying for this service, they had really good returns, but there's not activity, so they're saying, why do I need to do this? If you're doing covered calls, you're doing put writing, et cetera, every one of those trades has a natural expiration date, whether it be a week, a month, a quarter, et cetera. Every time you do one of those, you're seeing activity in the account. So that when a client looks at their statement, they see all these different trades, the premium coming in. Even at the end of the day, if the returns were the same, the idea that they saw this activity going on, it kind of gives them a feeling that they're getting something out of what they're paying for, if that makes sense.
We were talking last night to my alter ego in Florida, Gary Franklin, and we were discussing who is tremendous at what he does at Raymond James, Paul, with strategies there, and I brilliantly became the conduit between their sort of equity strategist and Gary offering sort of the overlay management for advisors there. And we were talking last night about how Gary said, clients are very fee sensitive, right? They're aware of what they pay, but if the value's there. And then Gary sort of said, when we talk about covered call strategies, that premium income we're bringing in, maybe within a couple of months could literally offset the fee for the whole year, and it's that aha moment. So this whole idea of that it's more expensive, or that there, again, one of these obstacles is that it requires a lot of maintenance. How would you react to that?
It does require a lot of maintenance. And going back to one of Mike's points is, technology, I think, plays a big part of it too. The technology in our industry just doesn't exist to manage multiple portfolios, be able to aggregate accounts, be able to do block trades, manage notional exposure, manage contracts, rolling contracts. I mean, it's complex, and for me, it's trying to build that infrastructure. It's challenging. I speaking to somebody at this conference, and they've actually built the technology, but our industry doesn't really know that it even exists out there.
Mm-hmm. So this awareness of bringing it, which is, I think, the wonderful thing of bridging that gap between sort of the buy side and the sell side, bringing the advisors here with the wonderful people in the industry to voice some of these concerns that are going on from the advisor space, maybe to see some enhancements from some of the people there. Mike, the obstacles that are there, for certain advisors, and if they decide they don't want to be that do-it-yourselfer, you're a good plumber and sheetrocker, and you could probably do your own electrical work, but maybe if it's roofing, you'd probably hire a contractor. Do managing advisors as you have, you wouldn't deter them from, say, looking at an asset manager who does an overlay strategy, if it maybe frees up time for them to do something that they're better in. Mm-hmm. And then they sort of become the general contractor and they can outsource that.
Well, there's 3 ways to go. Lou DePaul, who we all know in Philly, is a good guy, and he basically spoon feeds advisors. Here's your 4 options for this call. You got to roll this, and so we have Benning, my old chap, has a pretty active desk where he basically does the work for the advisor.
Right.
That's for number one. Number two, using products that then incorporate covered call writing or put selling closed-end funds without you actually doing the day-to-day managing of those options. And then I also think that if you have a significant client hedging a concentrated equity position and being able to articulate that into, here's your upside, here's your downside, a cashless collar, whatever that might be. That's a third way I think that we can differentiate ourselves as advisors. I would say that somebody came up with a question here about the client base.
Yeah, I'm gonna ask. It's interesting. I'm gonna summarize it here, and I appreciate people sending the questions in. So talking about a lost generation, we go back to the financial crisis of '08. For those of you who have forgotten those names, Lehman and Bear Stearns, and such. But now with a client base that's getting younger, and we talk about millennials being very conservative. I'll ask Brandon this, and then we'll have everybody else weigh in on this. Do you find that group being active, that millennial area?
I would say active, but not nearly as active as the older generation, or maybe it's different products. So the younger generation, I fall in that millennial category. The ones that I talk to are more inclined to use things like index funds, the robo-advisor kind of thing, because one, they've been told their entire life that nobody can beat the market, and index funds are a very low-cost way to get into it. So, I know on our side, on the institutional, we have a robo-advisor platform that the advisor can, create the allocation and we'll do it for them. So I think a lot of the trust needs to be rebuilt because these millennials grew up through the financial crisis. They got out of school. Now they really can't find jobs. They have all this student debt. So investing is that, way out there. But at the end of the day, the current generation is getting older. There's a tremendous amount of wealth that's about to be transferred to that generation. So even if we're starting with them on something like ETFs, et cetera, because the balances are smaller, it's low cost is what they know. I've had a lot of success when you have clients that have, $500K, $1 million, $2 million, et cetera, saying instead of buying these individual index funds, let's look at breaking it down and owning the sub-pieces like all the individual stocks. And it's like owning the index fund, but we're going to pick and choose, the best stocks out here, kind of like what we're doing right now. So it takes the clients and they get comfortable with an ETF, then we kind of deconstruct it for them, and then it makes it kind of an easy segue than trying to have a person that's 31 years old get into an all-stock portfolio. It's just probably not going to happen right now.
Yeah, I think I'll ask you, Paul, and I'll tie this question in as well. My colleague JJ, who was up here yesterday, who did a spectacular job with the panel, JJ Kinahan, I think was talking about misconceptions in the option industry. I hear it a lot when I'm out in the field where advisors will, the first reaction is, options are risky. And I usually say, look, there's sort of rhetorically, there are three outcomes when you buy a stock. It goes up, down, stays sideways. Can you tell me when that happens? No, I can't. Well, you have, you can with option contracts. And that, options, most options expire worthless, which we know is not true. So, the misconceptions that are in the industry right now carry from the client to the advisors as well. How do you get past that?
It's education. Education.
I didn't ask him to say that, folks. Please, anybody from OIC, that was not a pre-stage question.
It was, for me, I just actually came out of a meeting earlier this week, and this client is worth a couple $100 million in real estate, has several investment accounts. I do a put-right strategy, and the first thing that comes out of his mouth is he basically lost $4 million doing this himself. And so, obviously, I'm kind of curious. What was the condition around that where that happens, and part of it is just understanding the product and using it for what it's intended for, and I think that's the barrier of entry also for like the millennials is just there's so much noise in our industries. Like, how do you decipher what's really fact, what's fiction, and what was done properly, what wasn't done properly, and for advisors and for us, it's this is kind of what we do 24/7. We live it, breathe it, and understand it. And I think you have that education process that you have to always continue to learn.
Fantastic. Mike, we've had this conversation, and I talked to a lot of advisors who either have integrated options in their practice and have, it's sort of that toolbox analogy. You sort of have that flathead and Phillips head and hammer on the top, but the other tools, the crescent wrench, all that stuff is falling below, and you've forgotten about it. So for the advisors that want to reintroduce options, and there's a question here about, is there a strategy that you recommend to clients sort of who are looking to harness or integrate volatility into their asset allocation model?
Well, I'd echo what Paul said about education. I think I see the options versus retail evolution from 99, 2000 when there was like a lockdown of new option accounts at the big firms. But then 08 happened, and there's reasons not to have the conversation, reasons not to have the extensive conversation about using options, and compliance departments are getting better. I think back to the education point, if I may, I think that everything that's out there, Joe and Eric do a great job at the OIC, Johnny Black at the NASDAQ. I mean, getting information out there, not only the advisors, but the clients is very important. Mm-hmm. The CNBC Options Action Show. I mean, it's kind of like a sexy way to jazz up, and we're preaching to the choir here, so you guys know what they're saying might or might not be correct. But, I mean, that visibility and the millennials are more, I mean, we hire interns out of Villanova every year, and these kids coming out of college are just, they're so far ahead of where we were in 1984, as an example. They just know the business. They're getting their 7 wins before they get out of school. These kids coming out of these good colleges are already way ahead of where we were when we were 22, 23 years old. So I think the education is the most important part. So the millennial question, to your point, I think that the millennials that understand the business are going to do way more options. And like you said, this transition of wealth that's going to happen where us financial advisors build, manage, protect, and transition clients' wealth, and we've taken care of the parents' money, and we get a relationship with the kids. We transition that down, and we just bring the option business down to the next generation.
Excellent. Brandon, the recent rise in interest rates as well has been on the mind a lot of clients. We've seen it with tax law changes. I know the four of us talked about that a little bit. Is there discussions that you're having with your clients right now, or are you hearing from your clients that there's a concern, that we're seeing the onslaught of higher interest rates, that maybe there's some things that we need to be proactive about?
Yeah, so on that topic, I mean, with the interest rates going upwards, that's going to make some equity investments look less attractive, like your big dividend, your AT&Ts, your Verizons, et cetera. Those companies had a lot of inflow of capital when rates were so low because it was worth taking the equity risk if you're tripling or quadrupling your yield. Now, with the 10-year right at about 3, people are kind of moving away from those. So one of the things that I'll do is incorporate maybe some collars, like he had mentioned, or actually I think you might have mentioned, selling covered calls, buying puts for protection on some of those. We'll also go through and hedge some of the portfolio with rates rising, especially if they have a big bond portfolio. We might buy puts on something like TLT, or something that if interest rates rise, and that thing is going to come down in value to help offset it. So I would say puts and calls and just options in general become a lot more defensive on our side. And then also when you're competing against bonds and interest rates are getting higher, if you're able to layer extra premium on top of the stocks, it keeps stocks looking sexy. They become less sexy the higher interest rates get. So this kind of keeps the clients in the stock side. Because in just a lot of the clients that I deal with, a lot of them feel that they don't really need an advisor to manage a portfolio of bonds, right? Because if they're only getting a 3% and they're paying you 1, they're walking away with 2. So the more stock that they own, the more they feel they need somebody minding the store on that. So if you can keep stock looking sexy for them with things like covered calls, et cetera, that I guess kind of keeps you in the game a lot more than if they transition more into fixed income with the rising rates.
We've got a couple minutes left here, and I want to obviously give these gentlemen a chance to sort of leave you with some words of wisdom, but I'll ask Paul real quickly. Mike mentioned something, and I'm fond of some of the folks on CNBC because they've been great mentors to me and have kind of come to my forums in the past and have shared their knowledge. But do you think that some of these programs or things that get delivered out to the retail client are a hindrance, and maybe cause some of this conversation about when the advisor says options are dangerous?
I would say, I don't know if it's necessarily a hindrance. I actually think it opens the door for a conversation because I think the clients hear certain key words and cue up to that. So when you're in a conversation, they might bring it up, but they don't really know what they're talking about. Mm-hmm. So I think it's an opportunity. I happen to enjoy shows like that because obviously you pick up stuff. But I think clients are also, learning, there's much more to, investing than just, simple, buy and hold. And there are, some products that can actually really help you.
We're seeing that the introduction, kudos to Morningstar to have created this option-based category now, and we have a lot of our colleagues here from the ETF providers, from asset managers. So, that being brought to the market, I think, helps raise awareness in the advisor space. Going back to that analogy of not wanting to be a do-it-yourselfer, but being that general contractor to bring in a manager that can help deliver a strategy, whether it's covered call, protect to put, et cetera, the collar strategy, and they might not have to worry about that early assignment or all the other nuances that go into the maintenance. So we're about a couple of minutes away from here. Maybe what I'll do is I'll ask each one of my panelists to kind of take about 45 seconds to give the audience your thoughts of the industry and your clients and maybe the excitement for the next 5 years in the option business.
All right, I'll start. I think to follow what Paul said about starting the conversation with options, and somebody sees something on one of the shows on CNBC, but they really don't understand it. I mean, that's a big opening to walk in and have lunch or have dinner and talk about what we do as professional financial advisors. So that's number one. Number two, I think that you guys don't deal generally with, in the room I would assume, the investment public, but it's all about emotion, fear and greed, powerful emotions, and you guys are professionals, and I know there's no fear or greed in this room, but when you're dealing with individuals, you're dealing with emotions. And then the third thing I would say is on our jobs is part of what we do in dealing with a $2, $3, $4, $5 million client is, it's not a good word, but entertain them. And if you have a managed account and you don't do any trades, there's reverse churning, there's compliance issues. So options keep you in the game. Options require you to talk to that client every
I'm going to use that options with the game as we're winding down here. I'm going to ask Brandon to do a 20-second here, and then I'm going to go to Paul because I don't want to be pulled off the stage. I'd like to be invited back next year. Brandon, go ahead.
So I'd say the way that I normally position options with the client is I tell them that I honestly think it's less risky to do a covered call than to buy a stock outright. And I'll put on a piece of paper and draw out exactly the scenario and what downside protection, what income they're going to generate. And then I ask them, let's just start with one covered call on 100 shares of something you already own. Worst case scenario, you've sold an asset that you own at a price that we're comfortable with. And then once they get into that and then they say, oh, that makes a lot of sense, it's very easy to blow that across the big account. But it takes a little bit of time because they have a friend that hurt themselves at some point trading options. And that's a big headwind to get around.
With that being said, I'm being told that we are down to our 5-second mark. So I'm going to leave you on the heels of your seats here. Paul will be around, as will Brandon, as will Michael. I want to give a big OIC, OCC exchange round of applause for these three gentlemen for taking time out of their schedules to be here with us today, to share their insights about the industry, and to encourage all of you, to come to the OIC and let us be more of a collaborator with you. That's what we're here for. So thank you all.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.